careful. We have to follow all the protocols and stay, stay at home or stay in office and not go outside a lot, and keep ourselves and our family healthy, because that is what is the most important thing in our lives. And yeah, and also I hope these webinar series that we've been conducting on behalf of Optotax is actually very useful and beneficial to professionals in your life. So these things will, we will keep conducting these kind of webinars and series, because Optotax being a technology and knowledge sharing platform, which is trusted by more than 50,000 tax professionals for their 1 million clients. So we keep on, we believe in knowledge sharing. We share knowledge through daily updates, through newsletters, compliance calendars, all through these kind of webinars with the best and the top faculties in India. So I really hope this is very helpful to you. And yeah, so a lot of curious people on the chats also. Good evening. Good evening to Ajay Gupta ji, Anshul Hasani. Good evening a lot. And thank you everyone for, coming to this webinar again. And now, without further ado, I'd like to introduce today's faculty, CA Rajat Powar ji. So CA Rajat Powar ji is a chartered accountant with experience in specializing in direct taxation, international taxation, tax transfer, pricing advisory, litigation, and research. He's also a team player with excellent leadership and communication skills, and is an objective of pursuing a career in international taxation, transfer pricing, advisory, and litigation, and expertise in the field of tax litigation and research. So apart from that, he's also an All India first rank in the examination of diploma in international taxation conducted by ICAI. He has also contributed various articles to various journals, including Taxman, ITAT Online, Tax Guru, and even ICAI journals, especially his article on AMP controversy, which was published in May 2021 journal. And also he has successfully completed India's certification course also. So really, really happy to have you on this platform, sir. I think CA Sachin Sinha ji has also joined us. So any remarks from your side, sir?
You're telling me, ma'am?
Yeah, sir.
Oh.
Because, okay, if because Rajat Powar ji will be taking the session, I thought.
Yes. Actually, I'm a big fan of Rajat. I thought let's join and listen his deliberation.
Okay, sure. Then please go ahead, Rajat ji.
Thank you.
First of all, thank you, Ramya, for such a warm introduction, and thank you everyone for participating in such a large number. I can see already more than 500 people have joined, that too on a Saturday evening. So that shows the kind of importance which we all feel regarding this topic of presumptive taxation and tax audit. And especially Optotax has done a wonderful job by keeping this session at the very crucial moment, as we will be starting with the tax audit season, and everyone will within few days will be sort of busy with everything like tax audits and all those things. So before that, it is time to sharpen our axis so that we can perform well in our tax audit season. So the topic is quite vast. There are some major amendments. So let us directly start with the topic rather than wasting any time. So what are we going to cover? First, we shall consider maintenance of books of accounts. Second thing, the provisions of presumptive taxation. And lastly, we shall move on to the tax audit part. Okay, so as most of us are already chartered accountants and tax consultants, so we are the persons who actually know how important it is to maintain proper books of accounts. Books of accounts from the very basic or the most crucial document or evidence right from the compliance stage till the appellate stage. That forms the very basis of everything. May it be your filing of ITR, may it be the assessments, appeals. Books of accounts are your main and the most basic documents which should be properly maintained. So why are we required to maintain books of accounts? Apart from the statutory requirements under the Companies Act, the Income Tax Act also specifies under some section and under subject to some conditions that books of accounts should be required to be maintained mandatorily. So which are the sections which require us to maintain books of accounts? It is section 44AA. So talking about section 44AA, section 44AA makes two categories among the taxpayers or the assessees. First one is of the specified professionals and the second is others. So for both of them, the provisions of maintenance of books of accounts is quite different and quite unique. So first, let us understand what is in the case of professionals. So as I said, section 44AA1 has specified a list of professionals in whose case maintenance of books of accounts is mandatory. So if you are any one of this professional, may it be a legal, medical, engineering, architecture, profession of accountancy, in which most of us may be covered, technical consultancy, interior decoration. These are the professions which are specified under section 44AA1. Apart from that, there are certain other professions which have been separately notified under the rule 6F, which are authorized representatives. So what do you mean by authorized representatives? Any person who is authorized to represent someone else. Now, while we are in tax practice, we have many occasions where we represent before the revenue authorities, may it be the income tax authority or may it be the GST authority. So when we represent on behalf of someone else, we become authorized representative. So any person who works as an authorized representative, they will also be covered under specified professionals. Apart from that, film artist. So what is the again meaning of film artist? Rule 6F specifies the types of people who will be covered under the film artists part. It's a quite exhaustive list. It covers many people like actors, cameraman, producers, directors, and so on. So if you are covered by that, then you are also specified professional. Apart from that, a company secretary or a CS and an IT professional. So these are all professionals which are specified professionals. So if you are a specified professional as specified under section 44AA1, you are required to maintain books of account even if you are earning a single penny. From the moment you are starting a profession, you are required to maintain books of accounts. So if you are not specified professional or you are engaged into a business. So now we covered two parts. First one, people who are into business or people who are into profession but are not specified professionals. So any professional other than those which were specified in section 44AA1 are required to follow these provisions of maintenance of books of accounts. So what are the provisions? You will be required to maintain books of accounts if your income exceeds rupees 1,20,000 rupees or your turnover increase exceeds 10 lakh rupees in any one of the 3 years immediately preceding the previous year. So suppose now we are in the year 21-22. So if your income is more than 1,20,000 or sales is more than 10 lakh rupees in either 2021, 1920 or 18-19, any one of the year, even if it is exceeding 10 lakhs in any 1 year, then also you will be required to maintain the books of accounts as what is specified that it should be only 1 year and not all 3 years. So the next question which automatically comes to our mind naturally is that what in the case of new business? So when we are having a new business, that time we won't have a turnover of previous 3 years or income of previous 3 years. So what would be the case in that case? Then the section specifies that you have to see that the income is likely to exceed. Means you have to estimate your income or estimate your sales, and if you feel that your income is likely to exceed the threshold, then you are required to maintain the books of accounts. Otherwise, you are not required to maintain the books of accounts. Again, one more thing, if you are an individual or HUF, the limit is marginally or slightly increased from 1,20,000 rupees for the income. The limit is increased to 2,50,000 rupees, and for turnover from 10 lakhs, the limit is increased to 2,50,000 rupees. So obviously for individuals and HUF, always there is a bit of liberal kind of stance regarding the act. So whenever we have any specific provisions for the individual or HUF being small taxpayers, we always have some liberal attitude towards them. But one more thing, that the amount specified are very minuscule. So considering that they were implemented a long years back ago, and then the inflation and all those things, so that amount is not quite a large amount, and so we will be required to maintain the books of accounts in most of the cases. Apart from that, there are other two clauses which specify maintenance of books of account. First is if you are covered by the deemed profit clause. So section 44 AE, which is the income from transport receipts. So if you have transport income and then you are claiming your profit to be lower than the deemed profit, you are required to maintain the books of accounts. Apart from that, there is a section 44 AD4, which brings in the block concept for the purpose of tax audit and maintenance of books of accounts. So section 44 AD4 is quite a complex section because of the recent amendment. So we will see it in the depth when we go to the business income part or tax audit part. So for the time being, I am parking this section 44 AD4, and we will see this section when we actually move forward to the tax audit part. So now we have sort of determined which assesses are required to maintain books of account and which are not. So the next question which we will be facing is, which are the books of accounts that we are required to be maintained? So again, section 44 AA provides some guidance for professionals. So if you are a professional, you are required to maintain these books of accounts. It is cash book, journal, ledger, and some other books of accounts which are normal books of account, nothing very special about that. But the problem which I think is that the section does not specify anything specific for maintenance of books of account in case of assessee in business. So, or other than specified professional. So what does the section say? The section says that you have to maintain such books of accounts as may enable the assessing officer to compute his total income. So any books of accounts you maintain, that should enable the assessing officer to compute his income. So that's the basic edifice on which the entire Income Tax Act builds upon, the concept of income. So anything and everything which empowers the assessing officer to compute the income and which empowers you to substantiate your income, that would be sufficient for the purpose of maintenance of books of accounts. Apart from that, because of so many accounting softwares and all these things, so I don't think that maintenance of books of accounts is such a big challenge in now the technology. Because of the technology, has been such an enabler for us. The next important question is the period of maintenance. So now we have seen that who are required to maintain books of accounts, what books of accounts are required to be maintained. The next question, for how many period are we actually required to maintain the books of accounts? Again, section 44 AA sort of which favors the professionals and provides guidance for professionals only. So section 44 AA says that if you are a professional, you have to maintain books of accounts for the period of 6 years. And if your assessment under section 147 has been reopened already, then you are required to maintain till the assessment has been completed. Okay, and for other persons, there is no specific time limit which has been prescribed under the Income Tax Act. Okay, so one question which I would like to ask all the participants, especially Sachin ji, as he's here, whether the period of 6 years as specified in Rule 6F will hold good, because there have been a substantial amendment in section 149. So as we all are aware that there were substantial amendments in section 149, whereby the finance minister had promised that the time limit of 6 years will be reduced to 3 years. Okay, but actually the time limit was not reduced to 3 years. Actually, there was one more condition that where your income has escapement is more than 50 lakhs and there are some evidence and all those things, then we can go back to 10 years. So will these 6 years hold good, or will it be substituted by 10 years? Because this amendment has not been brought in by Rule 6F by the Finance Act. So what do you think will be the position after the amendment in section 149 by the Finance Act? Any views on that? You can just type in chat box. Chandrasekhar ji, the books can be maintained in soft copies, especially after we are going to the faceless assessment era. So I don't think that maintenance of books of account via soft copies is any problem. Hindi, maybe some people maybe from South, so they may not be understanding Hindi. I don't know. Anyone from Companies Act require for more than 6 years? Okay, that is a requirement under Companies Act, so that would prevail in Companies Act. But for income tax purpose, that was 6 years. So income tax के लिए जो provision था वो 6 years का था. So after this amendment in section 149, that 6 years, वो जो 6 years है उनका provision बढ़ के 10 साल का हो जाएगा. We are looking solely at Income Tax Act, Mareswari ji, because there may be some requirements under the other acts. So that is not a purpose for today. We are solely looking at Income Tax Act. Okay, so let me continue in English only, because that is most preferred language for everyone. Okay, so in my opinion, the time limit of 6 years has now to be read as 10 years, because the time limit of 6 years was specified in the rule, and section 149 specifies the time limit in Act. So a rule cannot override the Act. So whenever something is specified in the Act, that would be applicable. So the time limit for maintenance of books of account have to be now read as 10 years in case of professionals. So for the business people, there was no guidance anyways. So for business, at least the time limit should be 10 years only. Can we have for section 44 AE as well as section 44 AD? Okay, so section 44 AE and AD we will cover subsequently. the time limit was 6 years from the end of the relevant assessment year. So that's why that could be 8 years, which you are referring to. Okay, so let us now move on to the penalty part. So whenever we have to implement any section, the most convenient way to implement any section is to levy a penalty or a fine for its non-compliance. So whenever some penalty is levied for non-compliance, then people automatically start following the law. A very lively example which we can all sort of relate to is the COVID example. So when there was no fine for not wearing masks, not many people were actually wearing masks, and when actually the fine was implemented for masks, then suddenly everyone started wearing masks. So similarly, income tax also, there are many sections of penalties. Section 271 AA specifies the penalty for non-maintenance of books of accounts. The penalty mentioned is penalty mentioned is rupees 25,000 rupees for non-maintenance. That is subject to section 273B, which specifies that if there is a reasonable cause for the failure to maintain books of accounts, then there shall be no penalty levied. So what is the meaning of reasonable cause? Reasonable cause is something by which a man of ordinary prudence could have been prevented to maintain the books of accounts. If you want to study reasonable cause more in depth, then you can refer to the judgment of Woodward, Governor, in the case of Delhi High Court, which is a Delhi High Court judgment. So apart from that, there is a requirement of section 274 notice, which has to be issued before levying any penalty under section 271 AA. So that brings us to the important section of presumptive taxation. So as we all know, Income Tax Act, it is a tax on income. So Income Tax Act provides various sections by which the income is computed, the quantum of income is computed, and the rate is specified in the Finance Act. Just excuse me a minute. So Income Tax Act specifies the various computation mechanisms. There are basically 5 heads of income. One of the head is business income. So for business income, there is a special chapter of profit and gains from business and profession, whereby the amount of profit to be computed is specified. Section 28 to section 43, 44 are the sections for computation of income. So the intent of the legislature of sort of bringing in presumptive tax is to simplify things. So what does this section of presumptive tax say? If you are a small taxpayer and you don't have that much time or that much expertise to follow the entire Income Tax Act, the maintenance of books of accounts and all those provisions, then what you can do is simply deem a certain percentage or amount of profit, and that's all. You are not required to maintain any books of accounts. You are not required to do any tax audit. You are simply free from everything if you are covered from the presumptive taxation scheme. The principal aim of the presumptive taxation scheme is simplification for the taxpayers in the computational mechanism. That is basically the main aim of presumptive taxation scheme. So what are the main sections? Sections are 44 AD, business profits, 44 ADA, professional profits, and 44 AE, transport profits. Apart from that, section 44 AB, which is the main section of tax audit. So these are all the main sections which we are going to cover in this session. before moving on to presumptive business profits or presumptive profession income, it's very important to understand what is actually the meaning of income and what is the actually meaning of profession. So business is defined in inclusive manner by section 2 subsection 13. Business includes any trade, commerce or manufacture or any adventure or concern in the nature of trade, commerce or manufacture. Profession includes vocation. So as we can see, the definition of business and profession is not quite clear, but it is inclusive. So anything and everything which you can imagine for business, that would be in the definition of business, and profession also, anything which you can imagine for profession, that would be included in the profession. One more thing which is sort of important is what is actually the difference between business and profession. So whenever we talk of profession, there are one or two important things. Profession involves application of a specific individual skill. Then profession usually contains a regulatory body which sort of regularizes the entire profession. And it's more of personal skill, like a doctor, like a chartered accountant, which involves some amount of personal skill and expertise and certifications and all those things that will be covered under the definition of profession. So the first and the important
There's a bit of technical issue. Speaker is joining back. Yeah.
I'm really sorry, my sort of internet went off. So section 44 AD. Section 44 AD is a special mechanism which sort of overrides section 28 to section 43C, which is the general computational mechanism. Section 44 AD is applicable only in case of eligible assessee engaged in eligible business. So what is the meaning of eligible assessee for the purpose of section 44 AD? Eligible assessee means an individual HAF or a partnership firm, but not an LLP, and who is a resident. So we can see that only small taxpayers are covered under section 44 AD and not large taxpayers. So if you are small taxpayer, then only you will be covered under section 44 AD. Apart from that, you are also required to be a resident. Non-residents are not allowed the benefit of Section 44 AD. Apart from that, if you are claiming any deduction under Section 10A, 10AA, 10B, 10B, A, or Chapter 6A under heading C, then also you are not an eligible assessee for the purpose of Section 44 AD. Means if you are claiming any profit link deduction, so people who claim profit link deduction are generally big assessees and big taxpayers. So if you are claiming a profit link deduction, you are not an eligible assessee for the purpose of Section 44 AD. So if you are governed by Section 44 AD, then a sum equal to 8% of the turnover or gross receipts, or such a sum, higher sum which is claimed by the assessee to have been earned, that shall be deemed to be the profit of the taxpayer. So what is the meaning of this term? Or sum higher than the aforesaid sum claimed to have been earned by the assessee. So if you are having a turnover of 100 rupees and you say that you are earning 8 rupees, which is 8%, then that much amount is your income, no issues with that. But suppose if you are actually earning 20 rupees and you are claiming that you have earned 20 rupees. So in that case, you have to declare 20 rupees as your profit and not 8 rupees as your profit. That is what is the meaning of this section. Although there are some controversies around this issue that once if you declare the profit as 8%, there are some tribunal judgments which are saying that once when you declare the profit of 8%, then there are no questions to be asked and the amount of 8 rupees is considered to be your final income. But one more thing which we have to consider or here is the applicability of Section 68-69 series. So what does the Section 68-69 series say? Section 68-69 say that if there is any income or any asset, the source of which is not explained, then that shall be deemed to be the income. So if you are declaring 8% as your profit, then the source of only 8 rupees will be explained. The 12 rupees which remains as undisclosed income, and if you purchase any asset out of that 12 rupees, or if you make any expenditure out of that 12 rupees, then there are high chances that that 12 rupees will be considered to be unexplained asset or expenditure or cash credit in that case, and then there may be addition under Section 69A, 69B, 69C, 69D. Although Section 68 would not be applicable in this case because you have not maintained the books of accounts, and that's why Section 68 is not applicable. But otherwise, that is something which you have to take care of while applying these provisions. And specifically when you are maybe earning more than 8% and you are still declaring your profit to be 8%, then something which you have to consider that the source for only 8 rupees will be considered and not source for anything above 8 rupees. One more thing which we can say from the recent amendments in the Income Tax Act, that the Act is providing more and more benefits to the digital transactions, and one part of them is Section 44 AD. So if your receipts are by way of banking, then the amount of 8% is replaced by the amount of 6%. So if you have banking receipts, so only 6 rupees or 6% would be considered the amount of income, deemed income, and and for the cash, then again 8% would be considered the income. So if you are earning 200 rupees, out of 200 rupees, 100 rupees is cash and 100 rupees is banking. So 100 of banking, you will be deemed to be 6 rupees of profit, and the remaining 100, it will be deemed 6 rupees of profit. So that would be 14 rupees of total profit. So section 44AD6 again carves out certain exceptions to applicability of section 44AD. So section 44AD6 again starts with a non-obstante clause. The provisions of this section, notwithstanding anything contained in the foregoing provisions. So 44AD6 overrides the section 44AD. Shall not apply to a person carrying on specified professional under section 44AA1. So as we saw earlier in section 44AA, the list of specified professionals, if you are among any of the specified professionals, you will not be covered here. Apart from that, if any person is earning commission or brokerage income, then also you will not be covered. And agency business is also not covered. The logic may be that the commission part would be very low, and so subsuming them in this section would not be quite possible for them. So as per the section 44AD, once you have opted for the presumptive or simplified scheme of taxation, then everything gets covered into that, and the 92% of expenditure is deemed, and the remaining part of 8% is your profit. So the deductions under section 30 to section 38 are deemed to have been already given full effect to, and then you are not required to claim any specifically other deduction, or you will not be eligible for any deduction from section 30 to section 38 that will be fully given effect to. Apart from that, if you have any depreciable business asset, then the depreciation would also be subsumed in the amount of 92%. So the implication of this is when you sell the asset. So when you sell the asset, the amount of short-term capital gain needs to be calculated, and for that purpose you have to calculate the deemed depreciation under section 44AD for as many years as you have used the asset. So for that many years you have to reduce the amount of depreciation, and for the remaining years, for the remaining amount you will be charged capital gain. So for the purpose of calculating capital gains, the depreciation shall be deemed to be allowed, and the WDV has to be calculated accordingly. That is what subsection 3 provides for. So let us now summarize the entire 44AD section. 44AD covers presumptive business profits, exemption from books of accounts and from maintenance of books of accounts and tax audit is provided. Eligible assessees are a resident, an individual, HUF partnership other than an LLP, and not claiming profit linked deduction. So these are all cumulative conditions which you are required to be fulfilled. Eligible business is a business other than transport business, 44AE business, and the turnover should be less than rupees 2 crores. So if you have a turnover exceeding rupees 2 crores, then you will not be eligible for the applicability of section 44AD. If you have a turnover less than rupees 2 crores, you will be eligible for the applicability of section 44AD. The purpose is again to facilitate the small and medium taxpayers from the rigorous burdens of the Income Tax Act or maintenance of books of accounts and tax audit. And the specific exclusions are specified professionals, commission or agency business. These are the specified exclusions, which means that if you are covered by any of this, then you are not eligible for section 44AD benefits. The amount of deemed profit 8%, 6% for banking, or such an higher amount as claimed to have been earned by the assessee. As I said, this Section 44 AD is a special scheme which overrides the general computational mechanism. We will also be calculated as if the depreciation is deemed to be allowed. One of the most important question is that the limit of 2 crores, whether it should be construed qua business or qua assessee, means if there is one assessee and the assessee is having more than one business, for example 2 business, 3 business, and individually the turnover of each business is less than rupees 2 crores, but considering the pan-wide or assessee-wide turnover, the turnover exceeds rupees 2 crores. So what would be the case, whether tax audit would apply assessee-wise or business-wise? You can just type in the answers in the chat box. Okay, some are saying assess. Majorly the answer is assessee. Some are also saying business, but majorly I can see assessee. So in my personal view, the limit is to be construed assessee-wise and not business-wise. The main reason behind that is the object of Section 44 AD. Section 44 AD is to facilitate the small taxpayers. So if the turnover limit is construed for the business, then the section itself will become otious and non-workable. So that would be something which everyone would be planning. They will set up small businesses and the turnover will be accordingly bifurcated among the businesses, and that's something which will not be the intent or the purpose of Section 44 AD. So that's why Section 44 AD is to be considered qua each assessee. There was a question regarding the stock Amanji. So when we go for presumptive profit, we just consider the turnover and the profit. The amount of stock would get automatically adjusted in the amount of cost of goods sold. So we have opening stock plus purchasing minus closing stock. That would be automatically adjusted under the cost of goods sold part, and the amount of 8% profit would be arrived after considering the cost of goods sold. Okay, so we now come to the most important question of applicability of tax audit, and now we will first consider tax audit in case of the business person. Section 44 AD, more specifically speaking. So let us first understand what is tax audit, why it was actually implemented, and why the government felt need of introducing tax audit. So tax audit has been an important tool to increase the efficiency of tax administration and to curb the menace of tax evasion. Sorry. So as we all know that at least the tax audit report of income tax, tax audit report described under the Income Tax Act Form 3CD is quite exhaustive. It covers many aspects and many reporting concepts regarding the disallowance and many things. So that actually helps the assessing officer when they are actually performing assessments to arrive at the total income. So that's why it brings in efficiency in the tax administration, and also it helps to put a check on the tax evasion to some extent, because any chartered accountant would verify the compliances which have been made before issuing a tax audit report. So that are the major advantages of Section 44AB or tax audit section. But as we all know that the government is committed to increase the ease of doing business and especially in the case of small enterprises. So as a part of that only, there were major amendments under section 44AB or 44AD by the Finance Act 16, 20 and 21. Although the provisions were actually introduced to reduce the amount of tax compliance on the part of the assessees, but they have rather created a confusion among the taxpayers regarding in what case is the tax audit applicable, in what case is tax audit not applicable. So it is very crucial for us to consider the applicability of tax audit in such case. So again, one question for all of you, that what do you think, because of these amendments, has actually the compliance burden on the assessees reduced? No, okay. So I have one answer which says no, okay, yes, increased. Okay, someone is saying that it is increased. Burden increased. Okay, so majority of answers are that burden is actually increased, or at least it has not reduced. Okay, so that's a personal perspective which we all have our opinion regarding. And I also don't think that there is much of a change regarding the compliance burden because of this amendment. Rather, the confusion has actually increased. Confusion has actually increased. Okay, so the tax audit under the Income Tax Act is provided under Section 44AB. Section 44AB provides the application or mandation of the tax audit. So if we again look in Section 44AB, there are various sub-clauses regarding various types of assesses or various types of circumstances. So first one is Section 44ABA. So what does Section 44ABA provide? Section 44ABA provides for tax audit in case of sales or turnover of gross receipts of assessee exceeding 1 crore. So if your sales or turnover exceeds ₹1 crore, you will be liable to tax audit under Section 44AB clause A. Okay, so far so simple, nothing much complex, but again the complexity a bit increased by the Finance Act 2020, whereby again to promote the digital economy or total cash 5%. Can you give me and see? Just typing this if you can. Hello. Hello. Can someone please confirm that they can hear me? Yes, okay. So there was a substantial amendment by Finance Act 2020, whereby if your total cash receipts or cash payments are less than 5%, then the limit shall be increased to 5 crores. So again, this was a measure to promote the cashless economy. And this limit of 5 crores would be further increased to 10 crores by the Finance Act 2021. So what is the position which is standing as of now in case of Section 44AB clause A? When the amount of turnover is less than 10 crores, you have to see that whether the cash receipts or payments are less than 5%. So if your cash receipts or payments are less than 5%, then you will not be liable to tax audit even if your turnover is from 1 crore to 10 crores, and if your cash receipts or payments, one of them, even if one of them is more than 5%, then you will be liable to tax audit. Okay, so I think it's not clear. Okay. Voice is clear, right? The voice is not clear. It is clear now. Okay. Okay. So let me repeat the part of section 44 AB proviso. So what does voice is not clear? This point is not okay. So can you hear me now? Voice breaking. No. Now is the voice better? Okay. Okay. So let me repeat section 44 ABA ka proviso. So what does the proviso say? 44 ABA specifies the limit of 1 crore rupees. So what has the proviso done? The proviso has increased the limit of 1 crore to 10 crore rupees when the amount of cash receipts or payment do not exceed 5% of aggregate receipts or payments. The limit of 5% is both the conditions should be satisfied. Your cash payments should also be less than 5%, and your receipts should also be less than 5%. If both the conditions are satisfied, then only you will be provided the benefit of increased threshold for the purpose of tax audit of rupees 10 crores. If the limit is not satisfied, even if one of the limit is not satisfied, then the limit of rupees 1 crore would be applicable and not the limit of 10 crores. I hope it is clear now. Okay, one more thing which has to be considered for the proviso of section 44 ABA, that you have to consider the total receipts and payments, not only the receipt and payment from the revenue account, but also the capital account, which means that if you have sold any asset, fixed asset, or even if you have raised any share capital or any loan, that also has to be considered while construing the limit of 5% of payment or receipt respectively. So can you hear me now? Is my voice clearly audible? Okay. One more thing is that if you have opted for presumptive tax, if your turnover is less than rupees 2 crores and you have opted for presumptive tax, then then the provisions of section 44AB will not be applicable. We will see this in depth in the next slides when we will actually consider the interplay between section 44AD and 44ABA. Then we will see. So for the time being, I'm parking this question, and when we will see the interplay, I will cover this up again. Okay, so the next clause which is applicable for the purpose of business is section 44ABE. So what does section 44ABE provide? Section 44ABE says that any person to whom the provisions of section 44AD4 are applicable, to him tax audit will be mandatory. So what is this section 44AD4? This can be viewed in two timelines. The first timeline being the timeline before Finance Act 16. So before the amendment by Finance Act 16, section 44AD was quite a simple and quite a plain vanilla section, whereby if you had to declare a profit of less than the deemed profit of 8%, you had to maintain books of accounts and you had to do the tax audit. Simple and sweet, closed, question closed. But this position has now been amended substantially by the Finance Act 16, and there are various various sort of issues in the applicability. So let us read first the section 44AD4 in depth. What does the section 44AD4 provide? When an eligible assessee declares profit for any previous year in accordance with the provisions of this section, and he declares profit for any of the 5 assessment years relevant to the previous year succeeding such previous year, not in accordance with the provisions of subsection 1, he shall not be eligible to claim the benefit of provision of this section for 5 assessment years subsequent to the assessment year relevant to the previous year in which the profit has not been declared in accordance with the provision of subsection 1. Such a long and complicated section for such a simple thing for presumptive tax, and this section is actually incorporated to make the life of assessors easier. So this took me, when I first actually read this section, it took me 2 or 3 rereads again to actually understand what was the meaning of the section, and God knows how the taxpayers would understand the meaning of this section. Anyways, trying to simplify what is the position, section 44AD4 provides that where the assessee declares profit as per the presumptive taxation scheme in a previous year, and in any of the 5 subsequent previous year, 5 of the immediately succeeding previous years, she declares profit not in accordance with the scheme, then he shall be not eligible for the purpose of declaring profit as per presumptive tax in the next 5 years. Let us consider a simple example. Suppose for 1920 you have declared profit as per the presumptive tax scheme, and now you are in 2021, and now you are saying that no, I don't want to declare profit under the presumptive tax scheme. मतलब मेरा 8% का profit नहीं हुआ, मतलब I have not earned a profit of 8%, and I have actually earned a profit of less than the deemed profit, and now I want to declare the profit as per the normal computational mechanisms of the Income Tax Act. So I want to declare low profit. So what would happen now is that the section 44AD4 would apply in this case, and you will not be eligible for claiming the benefit of presumptive tax not only in the year 2021 but also 4 years which succeed the year 2021. So 2021 you would lose the benefit of 44AD anyways because you don't want to apply it. The remaining 4 years from there, 21, 22, 23, 23-24 and 24-25. These 4 years also you will not be eligible for the benefit of presumptive tax scheme, and you would be required to maintain books of accounts, and applicable and tax audit would be applicable irrespective of your amount of turnover. Even if you earn a turnover of rupees 1 lakh rupees, then also tax audit would be applicable. No matter how much amount of profit you declare, to 20%, 30%, 100%, then also tax audit would be applicable. So in short, if you opt out of the scheme of the presumptive taxation in any 1 year, then for the next 4 years you automatically opt out of the scheme of presumptive taxation. No, not only you opt out of the scheme of the presumptive taxation, but also you would be required to maintain your books of account and the tax and get them audited irrespective of the amount of your profit or turnover. So section 4485 specifies that only, that when you are opting out of section 44 AD, you would be required to maintain books of accounts and get them audited. One more thing is that this condition of opting out would be applicable for only 5 years. So after that specified block period or time period of 5 years, you can again opt in for the presumptive taxation scheme and declare profit of 8% or 6%, as the case may be. So what do I think that why this kind of difficult or complex provision of section 44 AD has been brought in? One thing which I can think of is to avoid the taxpayer from frequently changing his stance, and to sort of act as a deterrent for that thing, that once you are opting for a presumptive tax, then you have to continue to opt for a presumptive tax for a longer period of time. And then again, one should not just swing in between presumptive and normal. That sort of seems to be the intention of the legislature behind bringing in this 44 AD4 ka block period. That is what one thing which I can think. So section 44 AD4, although this section is quite clearly worded as such, but there are some ambiguities regarding its initial years of operation. So what would happen where we are considering the applicability for say assessment year 1920, which is prior to assessment year 1718. So this provision was made applicable from assessment year 1718 by Finance Act 16. So before 1718, there was a simplified version of section 44 AD, that if you want to declare profit lower than the deemed, then get your books of account audited and simple question closed. Next year, we won't ask you whether you had actually opted for presumptive tax in your early years. So that was that simple. So if I was not opting for presumptive taxation scheme, suppose in assessment year 16-17 or assessment year 15-16, then I would not have contemplated that I would not be eligible for opting the presumptive tax scheme in assessment year 1920. But now I am in assessment year 1920. Then, because I had not opted for assessment for presumptive taxation scheme in assessment year 16-17, the block of 5 years becomes applicable for me in assessment year 1920. And going by the literal interpretation of the provisions, then I'm in a problem that I would not be eligible for opting presumptive taxation scheme in assessment year 1920. That is what is contemplating as per the literal interpretation of the provisions. Okay, that is what is the literal interpretation of the provisions. But one thing we have to appreciate here, that is the genuine hardship which would be caused to some taxpayer, because as I said, they would not have contemplated that they would not be eligible for opting presumptive taxation in the next years. So that's why it affects the vested right of the assessees to opt for presumptive taxation in the subsequent years. And that will also amount to giving a retrospective effect to the provisions of Section 44 AD4, because that would be applicable for the previous years also. That was not the intention of the legislature, because the provisions of Section 44 AD4 were made to be specifically applicable from assessment year 17-18, and giving an interpretation that the block period has to be construed before the assessment year 17-18 would cause to giving a retrospective effect to Section 44 AD4. Then again, one thing which we have to keep in mind is the circular number 3 of 2017, which was explaining the provisions of the Section 44 AD. So in that also circular, there was a specific example which was cited, where they had said that if you want to declare profit less than 6% or 6% or 8% as the case may be, then you have to maintain the books of accounts and do the tax audit as may be applicable, and you would be required to comply with that provisions. But once you comply with that provisions, you will be eligible to declare a lower profit than 6% or 8%. One more thing which I noticed in the circular was that they also consider the assessment years subsequent to 17-18 for the purpose of determining the applicability of tax audit. So that's why in my personal opinion, the block period has to be from assessment year 17-18 and subsequently, and not the assessment years prior to assessment year 17-18, when the Section 44 AD was sort of not applicable. So let us, because these sections are very difficult, so let us consider a few examples which will help us to understand the provisions of Section 44 AD more effectively. So there are simple examples for to help us to understand. Consider a case where turnover of assessee is 85 lakh rupees, profit is 5.5 lakhs, and the assessee has not opted for presumptive tax in the 5 preceding years. So what would be the applicability provisions? First, Section 44 clause A, 44 AB clause A, as the turnover is less than rupees 1 crore, clause A would not be applicable, and you would not be required, you will not be liable for tax audit under clause A. Second is the applicability under Section 44 ABE, which is the presumptive profit wala tax audit ka clause. So now, as we have not declared profit as per the presumptive taxation in any of the 5 preceding years, that's why I am not hit by the provisions of Section 44 ABE. Even though I am not declaring profit as per presumptive tax, I am not hit by the provisions of Section 44 ABE, because I have not declared profit in any of the 5 preceding years as per the provisions of Section 44 ABE. So tax audit will not be applicable in this case. One thing which we have to consider, very important thing, is that the provisions of Section 44 ABE or provisions of Section 44 AD, what they provide, that when you have opted out of the provisions of presumptive taxation, then only the tax audit will be applicable. If you have never opted for presumptive taxation as such, and you are now also not opting for presumptive taxation, then the provisions of presumptive tax then the provisions of tax audit will not be applicable for you, irrespective of the amount of profit. So the profit may be less than 8% or 6%. Then also tax audit will not be applicable if you have not opted for tax audit under section 44 AD. So that is a very crucial thing which we have to keep in mind. Just I will be sharing my PPT with the Optotax team, and they can share it with you. I don't have any issue with that. So consider a second case where turnover of the assessee is rupees 1.5 crores. So now the turnover has exceeded rupees 1 crore, which is the threshold limit as per section 44 ABA. Cash receipts or payments are rupees 15 lakhs. So they are more than 5%, they are around 10%. So the proviso of section 44 ABA will not be applicable, and the turnover limit will be 1 crore only. And the profit is 7 lakhs, which is also less than 10%, and we have not opted for presumptive tax in the preceding 5 years as well as the current year. So as I said that the threshold limit applicable is 1 crore rupees, and as the turnover is exceeding 1 crore rupees, then the tax audit will be applicable in section 44 ABA itself, and there is no requirement to see the application of section 44 ABE. So we now move on to the example number 3, where turnover is rupees 1.5 crore. Cash receipts or payments are rupees 5 lakhs, and profit is rupees 7 lakh. And assessee has opted for presumptive tax in one of the 5 preceding years. So let us first consider the applicability of section provisions of section 44 ABA. The turnover is 1.5 crores and the cash receipts are rupees 5 lakhs. That is less than 5%. So the increased threshold of 10 crores would be applicable, and you will not be liable to tax audit under section 44 ABA at least, but we have to still check the applicability of tax audit as per the provisions of section 44 ABE. So let us check the applicability of provisions of section 44 ABE. Now, you have opted for presumptive taxation in any of the 5 preceding years, and you are now not opting for the presumptive taxation in the current financial year. So automatically you will be hit by provisions of section 44 ABE, and you will be liable to maintain books of accounts and get them audited as per the provisions of section 44 ABE read with section 44 AD4. Now again, consider the last example where the turnover of the assessee is rupees 2.5 crores rupees. The turnover is of course exceeding rupees 1 crore, which was the limit of applicability of section 44 ABA. Cash receipts or payments are rupees 10 lakh rupees, because which is less than 5%. So the limit of 10 crores will be applicable. Profit is rupees 8 lakhs, so that is less than the presumptive profit rate, and we have not opted for presumptive tax in this case. So applicability of 44 clause A. As the cash receipts are less than 5%, the increased limit of 10 crores will be applicable, and we will not be liable for tax audit under section 44 ABA. Moving to clause E. Now, as the turnover of the assessee is more than rupees 2.5 crores, the assessee is not an eligible assessee or eligible business as per the provisions of section 44 AD. So you automatically get out of section 44 AD and you are not eligible to declare profit as per section 44 AD. So what is happening is that you are not entitled to declare the profits and you automatically get out from the provisions of section 44 AD. So as you are out from the provisions of section 44 AD, you are not required to check the applicability of tax audit under section 44 AD4 read with section 44 ABE. So tax audit will not be applicable under 44 AD4 read with section 44 ABE also in this case. Okay, so I hope that at least some things would be clear at this point of time. I have a question for all of you in the next slide. The question is based on the example 3 and example 4. So for example 3, where the assessee had the turnover of less than rupees 2 crores, he was an eligible assessee for the purpose of section 44 AD, and profit was declared less than 6% or 8%, and then the tax audit was applicable to him under section 44 ABE. But when you actually see the example number 4, the assessee was having turnover exceeding rupees 2 crores, okay, and the tax audit was not applicable for him, even though the profit was less than 6% or 8%. So what has actually happened for example 3 and example 4, where the assessee was having less than rupees 2 crores of turnover? For that assessee, tax audit was applicable. But for the assessee who was having turnover of more than rupees 2 crores, for him tax audit was not applicable. How come? As I said, the object or the purpose of section 44 AD was that to provide relief to the small taxpayers. So by these provisions, there is a sort of an anomaly whereby a benefit is provided to the large taxpayers having turnover from 2 crores to 10 crores, while the taxpayers having turnover less than 2 crores are subjected to the greater compliance burden of the tax audit for when they have shown less profit. So this appears to be something which may not be treating the persons equally, because this may be something which is in violation of Article 14 of the Constitution of India, where two persons are not treated equally. So what are your views regarding this? Is this position valid, or what do you personally think about this anomaly? Whether this is a fair position or not? What are your personal views? Please, you can type in the chat box. Someone is saying that tax audit is not applicable. Actually, I'm not asking about the applicability of tax audit because that has been covered already. What I'm trying to ask is whether this position fair, where the small assessees are not treated favorably than the large assessees. Okay, someone is saying this is not favorable position as far as assessee is concerned. Someone is saying that tax audit under section 44 AB is done, not fair. Okay, not fair, not at all fair. Okay. Okay, I can understand your feelings. Okay, not fair. So most of you are saying not fair. Available since cash transaction below 5%. Okay, Rajesh, cash transactions are below 5% in both the cases. So where the turnover was less than 2 crores, then also the cash transactions was less than 5%, and here also then same thing is there for greater bank through transactions. Please share the PPT. Just I'm sharing the PPT, don't worry. Okay. Okay, so let me just share my views regarding this issue. Okay, so if we see example number 3, now there are two clauses of tax audit as such: tax audit under section 44 ABA and tax audit under section 44 ABE. Both of them have different spheres. Both of them are not to be confused. If we confuse the tax audit under section 44 AB with the tax audit under section 44 ABE, there will be problems. So both are separate and different provisions which are not to be confused with each other. So in example 3, the tax audit was applicable under section 44 ABE, where the purpose of the section 44 ABE was that to prevent the assessee from shifting from one section to the next section, from presumptive to the normal in one assessment year and the next assessment year. While in example 4, the tax audit was applicable under section 44 ABA, where the limit was a threshold based limit, where the benefit is not allowed for the assessees with large turnover. So both of them operate in a different sphere, and both of them are not to be confused. Going a step forward, I can say that the example 4 part. Okay, so now in example 4, even if I was to declare my profit as per the presumptive tax scheme, I will not be eligible to declare the profit from the presumptive tax scheme. Even if I am ready to pay the taxes as per whatever may be the profit, still I am not eligible. Rather, that is impossible for me to declare profit under the presumptive tax scheme without my fault, any fault. Still I am not eligible to declare the profit as per presumptive tax scheme. So why should I be punished if I am not eligible for presumptive tax scheme only? So that is one more logic which has to be understood for the purpose of this for the purpose of these provisions, which is to be considered. So again, let me try to summarize all the complex part of tax audit and section 44 ADN presumptive tax part for the best benefit of everyone. So this is a chart which I have summarized almost the entire scenarios which could occur for a practical life, starting from 1 to 4 scenarios. So first, consider the first one. First, we have a turnover exceeding rupees 10 crores. So whenever we have a turnover exceeding rupees 10 crores, then tax audit will be applicable, and we did not see anything else. Okay, so let's move to the second case, where the turnover is from 2 crores to 10 crores. So the next question which I will be asking is whether cash receipts or payments are greater than 5%. So if the answer is yes, then the tax audit will be applicable. So from 2 crores to 10 crores, you are automatically not eligible for presumptive taxation scheme. So the cash receipts are more than 5%, then you are not eligible for the proviso to section 44 ABA, and tax audit will be automatically applicable for you under clause A. Okay, so when your cash, in the third example, when your cash receipts are not more than 5%, then the threshold of 10 crores will be applicable. The provisions of 44 ABE are not applicable as you are not an eligible assessee, as your turnover is more than rupees 2 crores. You are not therefore presumptive tax also, because your turnover is more than 2 crores. So tax audit will be applicable as the threshold is tax audit will not be applicable as the threshold is 10 crores and your turnover is from 2 crores to 10 crores. Okay, so let's move to the next example, 1 crores to 2 crores. Whether your cash receipts are more than 5%, no. So the limit of 10 crores will be applicable to you. Okay, so but as my turnover is less than 2 crores, I am an eligible assessee for the purpose of section 44 AD. So, we are required to ask the next question, whether the profit has been declared as per the presumptive taxation scheme in any of the 5 preceding years. If the answer is yes, then again we have to ask one more question, whether opted for presumptive taxation in current year. So if you have not opted for presumptive taxation in current year, but you had declared profit in any of the 5 preceding years as per the presumptive taxation scheme, then the tax audit will be applicable under section 44 ABE, 44 AB clause E, and you will require to be get your books of accounts audited. Okay, so the third example where the cash receipts are more than 5%, then you will not be eligible for the increased threshold. You had declared profit as per the presumptive tax, and now you are not declaring the profit as per the presumptive tax. So your tax audit is applicable under both the sections, 44 ABA as well as 44 ABE. Okay, so the next one where you are opting for presumptive taxation. So once you have opted for presumptive taxation, then you are not required to satisfy any other condition. Straight away, tax audit is not applicable for you. So the next, where the cash is more than 5%, the threshold of 10 crores is not applicable, threshold of 1 crores is applicable, but you had not declared the profit as per the presumptive taxation scheme or for the current as well as the past years, then also tax audit will be applicable as your turnover is exceeding rupees 1 crore. Next is the case where the cash is less than 5%, not opted for presumptive taxation in current year and for the previous years. So the tax audit will not be triggered under section 44 ABA or E. Similarly, I have shared the 44 other parts also, which you can go through. Actually, I'm skipping this for the time being because we have a time constraint. I have made a decision chart which will also help you to understand the applicability of tax audit. So there are actually two charts. One is for the assessee who are not eligible for presumptive taxation under section 44 AD, maybe it a company or any other assessee. Then these are the questions which you will be required to be asking for the purpose of determining the applicability of tax audit, whether the turnover exceeds rupees 1 crore. If yes, then if no, then tax audit is not applicable. If yes, then the next one, whether the cash receipts or payments are more than 5%. So if your cash receipts or payments are more than 5% and you have turnover of more than 1 crore rupees, tax audit is applicable. But if your cash receipts are less than 5%, then the threshold increases to the rupees 10 crores, and if the 10 crores threshold is breached, then tax audit is applicable, otherwise tax audit is not applicable. Then the next example, next chart is for person who has opted for presumptive taxation scheme. So the first question is whether the assessee has opted for presumptive taxation scheme. Yes, then tax audit not applicable. You straight away go out of the provisions of section 44 AB when you have opted for tax for presumptive taxation. If not opted, whether the assessee has opted for presumptive tax in the preceding 5 years. If you have opted for tax or presumptive taxation earlier, then tax audit will be applicable under section 44 ABE. If you have not opted for presumptive taxation in the preceding 5 years, then again one more question, whether the turnover exceeds rupees 1 crore rupees. If your turnover does not exceed 1 crore rupees and you have not opted for presumptive tax in the preceding 5 years, tax audit will not be applicable for you, irrespective of the amount of income which you are earning. So where the turnover limit exceeds rupees 1 crore, then the next question is whether cash receipt or payment exceed rupees 5%, exceed 5%. So where the cash payment does not exceed 5%, then tax audit not applicable for turnover up to rupees 10 crores. And where the cash payment is more than 5%, then tax audit is applicable for turnover exceeding rupees 1 crore. Okay, so I think that this section must be you must be more comfortable with this section now that we have completed this part of section 44 AB, which is a quite complex part, but I had tried my best to sort of summarize things and clarify the things by giving examples, and I surely think that you will be much more comfortable when you are actually going to decide the applicability of tax audit going forward. Okay. So the penalty for non-compliance, as you all must be knowing, the penalty is 0.5% of sales or rupees 1,50,000, whichever is less. The provisions of section 273B and section 274 are applicable. Okay, so now we move on to the next part, section 44 ADA, professional income. So what does section 44? Okay, Sayyaf Mohammed Sir, turnover rupees 85 lakhs, cash payment more than 5%. Not applied 44 AD in last 5 years, is tax audit applicable? Okay, so this was the example which I think I had covered, that if you have not opted for tax audit for the 5 previous years, then the tax audit then the tax audit 44 ABE clause will not be applicable because the amount of because you have not opted for presumptive tax for the past 5 years. Then the next part is the section 44 ABA. Section 44 ABA will also not apply because the turnover is less than rupees 1 crore. So you are out of section 44 ABA as well as 44 ABE, and tax audit will not be applicable in your case. I hope that is clear now. So now, considering the time constraint, now we have to move to section 44 ADA, that is the professional part, professional income, presumptive professional income part. So what does section 44 ADA subsection 1 provide? Notwithstanding anything contained in section 28 to section 43C, same as 44 AD was providing. In case of assessee being individual or part, same as section 44 AD was providing. For a individual partnership other than LLP, okay, who is a resident and is engaged in profession referred to in subsection 1 of section 44 AA. The list which we saw in the first slide at the beginning of the session, legal, medical, accountancy, CSM, that part of the list, for that person, this section 44 ADA is applicable, and your sales should not exceed 50 lakh rupees, and 50% or some or more shall be deemed to be your income under profit and gains from the business of profession. So this section is not that complex. Trying to summarize, section 44 ADA, presumptive professional profits. Conditions for applicability, he should be a specified professional under section 44 AA1. He should be a resident, and should be an individual partnership other than LLP, which has been in recent amendment, and the gross receipts are less than rupees 50 lakhs. And if you are covered by section 44 ADA, then you will not be required to maintain books of accounts and get those accounts audited. So deemed profit is 50% or such a higher amount, special scheme, which it is a special scheme, same as section 44 AD. So I am not repeating these things because we have a time constraint. Now we can see the provisions of applicability of tax audit. So for professionals, there are two sub clauses for applicability of tax audit, not quite complicated sections, which I would say. Clause B provides a threshold for the turnover. When your turnover exceeds rupees 50 lakhs, you will be required to do tax audit. That is what clause B says. And clause D says that where you are declaring profit less than 50%, you are required to do tax audit. I don't think there will be any sort of confusion in these sections because they are quite clearly worded and not ambiguous. So I am not spending much time on this. If you have any questions, you can actually type regarding the professional income part. This is a decision chart which I have prepared for the professionals. So the first question is whether the turnover exceeds rupees 50 lakhs. If yes, tax audit applicable under clause B. If no, second one, whether profits declared as per the presumptive tax rate of 50% or more. If no, then tax audit applicable under section 44 ABD. If yes, tax audit will not be applicable. Quite simple and quite not complicated part, which I can say. This brings us to the last part of our session, which deals with the uh, business of transport receipts, section 44 AE. So what does section 44 AE provide? Notwithstanding anything in section 28 to section 43C, in case of an assessee who owns not more than 10 goods carriage at any time during the previous year and who is engaged in the business of plying, hiring, or leasing such goods carriage, the income of such business chargeable to tax under the head profits and gains of business or profession shall be deemed to be the aggregate of profits and gains from all the goods carriage owned by him in previous year, computed in accordance with provisions of subsection 2. So what subsection 1 specifies that section 44A is applicable for the business of plying or hiring. Shortly, the transport business part. And the computation mechanism is specified in subsection 2, and you should not own more than 10 goods carriage for this section to be applicable to you. So if you are having more than 10, then you are automatically out of section 44A. Okay, so the computation part, section 44AE makes again two subcategories regarding the computation part. One is regarding the heavy goods vehicle, and the next one is regarding other than heavy goods vehicle. Okay, so being a heavy good vehicle shall be amount equal to 1,000 rupees per ton of gross vehicle weight or unladen weight, as the case may be, for every month or part of the month during which the heavy goods vehicle is owned by the assessee in the previous year, or amount claimed to have been actually earned from such vehicle, whichever is higher. Other than heavy goods shall be amount equal to 7,500 rupees for every month or part of the month. So for heavy goods, the amount is 1,000 per ton, and for other than that, 7,500 flat amount for every month. I hope this is also clear, because this is also not quite difficult provision. The subsection 5 of section 44A provides that the provisions of section 44A and B, which are maintenance of books of accounts and tax audit provision, shall not apply insofar as they relate to the business referred to in subsection 1, and in computing the monetary limit under those sections, the gross receipts, or as the case may be, the income from the said business shall be excluded. So whatever is your income from the heavy goods vehicle or others which you have declared under section 44AE, then that should be excluded for the purpose of calculation of the turnover limit, 1 crore or whatever that may be, for the purpose of section 44AA or section 44AB. So trying to summarize section 44AE, section 44AE deals with the presumptive business profits from plying, hiring, or leasing such goods carriage. Exemption from maintenance of books of accounts or tax audit is provided. Eligible assessee is the assessee who owns not more than 10 goods carriage, even if the goods carriage are taken on hire or lease, then also you are entitled to the benefit of section 44A. The main thing is that you should own the goods vehicle, and they should be less than 10 in number. The amount, as I said, rupees 1,000 per ton of gross vehicle weight or unladen weight, and other than heavy goods vehicle, 7,500 rupees flat per month. Other things of section 44AD are the same. Okay, so there are some important definitions for the purpose of Section 44 AE, which have been provided by an explanation to Section 44 AE. The expression goods carriage, gross vehicle weight, and unladen weight shall have the respective meaning assigned to them in Section 2 of the Motor Vehicles Act 1988. So what does this do? This explanation borrows the definition of goods carriage, gross vehicle weight, and unladen weight from the Motor Vehicles Act. What is the definition provided under the Motor Vehicles Act? That we will see in a short while. The second definition which has been provided is of heavy goods vehicle. The expression heavy goods vehicle means any goods carriage, the gross vehicle weight of which exceeds 12,000 kilograms, which is 12 tons. So if your gross vehicle weight exceeds 12 tons, then you are an heavy goods vehicle. Okay. So there is one difference in the definition of heavy goods vehicle as per the Income Tax Act and the Motor Vehicles Act, which I think is relevant for the purpose of understanding one concept of unladen weight and gross vehicle weight, which I will link forward after some time. So as per Income Tax Act, heavy goods vehicle, as we saw, is something which has weight of more than 12,000 kgs. And as per Motor Vehicle Act, heavy goods vehicle means goods carries the gross vehicle weight. The gross vehicle weight is more than 12 tons, and for tractors or road roller, the unladen weight is more than 12,000 kgs. Okay, so let's sort of go forward and understand the concept of gross vehicle weight and unladen weight. So as per the Motor Vehicles Act 1988, from which the definition is borrowed, goods carriage means any motor vehicle constructed or adapted for use solely for the carriage of goods, or any motor vehicle not so constructed or adopted when used for carriage of goods, means something which is used to transport the goods, that is a goods carriage. Gross vehicle weight means in respect of any vehicle, the total weight, the vehicle and load certified and registered by the registering authority as permissible for that vehicle. So gross vehicle weight means two things. First thing, the vehicle weight and the load certified, means the vehicle plus the load which the vehicle can actually carry, that is included in the gross vehicle weight. And the second thing is unladen weight, means the weight of a vehicle or a trailer, including all equipments ordinarily used with the vehicle or trailer when working, but excluding the weight of driver or attendant, and when alternative parts or the bodies are used. The unladen weight of vehicle means the weight of vehicle with the heaviest such alternative part of the body. So one difference between the unladen weight and gross vehicle weight is the gross vehicle weight includes the load certified, while unladen weight is only the weight of vehicle. It does not include the load certified. So if I go back again to the main section 44 AE, that says that the amount of rupees 1,000 rupees per ton of gross vehicle weight or unladen weight, as the case may be. Okay, so this creates again one more confusion as to when we have to take gross vehicle weight and when we have to take unladen weight. Okay, so because the difference would be much more, because the load is not included in the gross vehicle weight, but the load is included in the unladen weight. So the difference you can see would be much more when we take gross vehicle weight or when we take unladen weight. So for this, let us again consider the definition of Motor Vehicles Act of Heavy Goods Vehicle. So For what basically happens that for tractor, there is a concept of unladen weight, and for tractor, there is no concept of gross vehicle weight under the Motor Vehicle Act. So going by that logic, when we have to consider the receipts of tractor, then we will consider the unladen weight, and when we are to consider the receipts of other vehicles, then we will consider gross vehicle weight. As simple as that. So that is something which is again accepted by the CBDT widest circular, that for the tractor or road rollers, there is no concept of gross vehicle weight, and the concept of unladen weight is applicable for them only. And for others, the concept of gross vehicle weight will be applicable. Can you hear me properly?
Yes, we can hear you, sir.
Okay, so so for the tractors, the concept of unladen weight is applicable. Considering the applicability of tax audit under section 44 ABC read with section 44 AE, the applicability is quite simple. When you are declaring profit lower than the amount of deemed profit, you are required to do tax audit. If your income exceeds the maximum amount not chargeable to tax, then you are required to maintain books and get your accounts audited. And if you are declaring profit more than the amount of deemed profit or that amount of deemed profit, then you are not liable to maintain books of accounts and get your accounts audited. Some of the FAQs which I thought I should cover are that that the deductions under section 30 to 38 shall be deemed to be allowed in full, and you will not be allowed any further deduction other than the 92% which is deemed to be allowed. Second thing is the disallowance, various disallowances under the Income Tax Act. So, as specified earlier, there are two mechanisms for computation of income: the general mechanism and the presumptive taxation mechanism. So once you go for presumptive taxation mechanism, the disallowances under the general mechanism would not apply irrespective of the compliances which are required to be made by you. The next thing is section 44 AD partners remuneration. Whether partners remuneration would be allowed from the 8% more, whether you are eligible to claim the partners remuneration from the amount of deemed profit. So the proviso to section 44 AD, which specifically allowed the deduction of partner remuneration and interest, was deleted. So now you are not. So now you cannot claim partners remuneration from the profit under section 44 AD, but you can claim the same from 44 AE. Applicability of section 68, 69, we have touched upon this in the first part of our section. Applicability of tax deduction at source provisions. Applicability is in case the turnover exceeds rupees 1 crore for business and rupees 50 lakhs for the professionals, irrespective of the applicability of tax audit. That is nothing to do with the tax audit. This has been a recent amendment. So this is quite clear now. One more thing is section 43CA. Section 43CA deems the stamp duty value of the land or building sold to be the deemed consideration. So for section 44AB or section 44AD, section 43CA, in my personal opinion, would not be applicable because that talks of deemed consideration and not the amount of turnover. So 44AB and 44AD would not be affected by the provisions of section 43CA. Coming to the next concept of unabsorbed depreciation or carry forward loss. Unabsorbed depreciation will not be allowed because that is covered under section 32 and you are already allowed the expenses under section 32 38. So you will not be you will not be able to claim the depreciation under section 32 of the prior years, but you can claim the carried forward loss because that is governed by section 70 and the presumptive tax does not bar claiming the carry forward loss of previous years. So that is something which we have to again consider. The next important point is the GST part of the turnover. Whether GST is to be considered for the purpose of determining the applicability of tax audit under section 44AB or for the purpose of deeming the profit under section 44AD. So there is a guidance note of the ICA that says that both of the methods are allowed, inclusive method and exclusive method. But one thing which we have to keep in mind is section 145A. Section 145A specifies that for the purpose of determining the profit, the taxes should be passed to the profit and loss account. In simple terms, section 145A specifies that all the taxes should be included in the amount of turnover. Even the ICDS specifies that the taxes should be part of turnover. So, considering the section 145A and considering the ICDS provisions, the tax audit for the purpose of determining the provisions of tax audit or the deeming profit under section 44AD, you have to include GST in the amount of turnover. I think that these are some of the judgments for section 68 or 69 which you can go through if you have further doubts regarding the same. That's all from my side. If we have some questions, we can maybe devote 5 minutes or so because it's already 7. So if we have some questions, we can take them up. Okay, Ankit sir has a question. I have. Okay, just a minute. Okay, Tarun ji has a question, sir. If person earn interest income by giving loans to people and this is his full-time work, can section 44AD be applicable? Okay, Tarun ji, there is no specific bar regarding the interest income part of this thing as per the provisions of section 44AD. There is no bar for income. But then again, you have to consider whether that is a business, whether you are into a business as per section 213. So for the purpose of being in business, there are specified tests, whether there is whether there is a continuous activity and so. So from that point of view, there may be some problems, but otherwise, I don't think that there are any problems for a person in this line of business to claim 44 AD ka benefit. Can you tell me if PF amount is not deposited within PF due date, then whether expense will be allowed and expense if deposited within due date of tax audit? Okay, so there has been an amendment. So now as per the amendment, you cannot claim the PF employees contribution if it has been not submitted within the due date of TF, even if you submit it before filing of your return. Can we say that we cannot opt for section 44 AD if my income is more than 8% of receipts? If yes, where do we use this section? Okay, so you can opt for 44 AD if your income is more than the deemed profit. That is something which is specified in section 44 AD itself by the way of, or such a higher amount as have to be claimed by the assessee. So, so there is no problem. If in the TDS we have to see previous year turnover. If turnover for this year is more than 1 crore, but previous year turnover is less than 1 crore, in this case, no TDS provisions are to be deducted. Yes, Suresh, you are absolutely right. There is no doubt regarding that. Whether judgment of Bombay High Court will no Kenilji, because there has been a and specific amendment, and for the years which are not covered by the amendments, surely Bombay High Court will help. But for the years which are post the amendment, the Bombay High Court for the Ghadge Patil transport case or many other cases would not help you, and the amount would be disallowed anyways. Sir, bank receipts means, what was that question I missed? Sir, bank receipts mean the total of credits of bank statement or only on transfers of online. Okay, bank receipts means the everything, RTGS and checks and all things except for the bearer check. That includes. Okay. I enjoyed the webinar, good presentation with examples. Thank you so much, sir. The pleasure is mine. Assessment year 2021, assessee had opted, assessee had professional income and salary income applied for 44 ADA. Now 2022, no professional income, only salary income. In case, should I file ITR 1 or ITR 4? Considering that future you might have. So you have to file ITR 1 because the assessment year is to be considered for that year only. So ITR 1, no ITR 4. So you can mention the ICA guidelines, note release date or your own. No, sir, I am not aware about the ICA guidelines. Sorry, sir. Please send us the PPT. Surely, sir, I will share it with the Optotax team as informed earlier. Thank you very much. Thank you, sir. Thank you so much. Okay, I think we can conclude if we do not have any questions. And are there anyone from Optotax? Ramya ji, are you there?
Yes, yes, sir. Yeah.
I think we can conclude. If you have any questions, I can surely take them. Otherwise, I have completed my PPT. I think we can conclude. Yeah. I will share it with you because many of the participants.
Doubts, so.
Thank you for this. For below 5%. 5% of total receipts. That is what has been said in section. Okay, I don't think there are any more doubts. And it's already 7:10.
So first of all, thank you to all the audience for being so interactive, for asking so many doubts, and connecting with the speaker also. So it shows how dedicated and interesting the session was also. So thank you again to CA Rajat Powar ji for such an amazing session. And definitely we'll be sharing the PPT and the recording also later on for your reference. So the best part is to obviously attend the live session. So we'll be expecting all of you tomorrow, same time, and day after also the same time. So till then, have a great weekend. Good night, everyone. Thank you.
Thank you, Optotax, for giving me this opportunity to deliberate on such an important topic, and surely this will help all of the participants going forward. Thank you so much.
Thank you so much.